Good evening, everybody, and welcome to our session today. So today we'll be focusing on trend analysis. So this is just to help us understand how we'd be in a position to identify the most optimal time to enter into a trade. To our session today. So today we'll be focusing on trend analysis. So this is just to help us understand how we'd be in a position to identify the most optimal time to enter into a trade. So trend analysis refers to the general market direction over a specified period of time. So one of the basic things when it comes to trading is knowing where the market is headed long term, and that would enable you as a trader to be able to know whether the prevailing trend would favor you taking buy positions, or whether indeed sell positions would be ideal. So trend analysis therefore refers to the study of price action or the study of price patterns using historical data to predict the long-term direction of the market sentiment. Trend analysis is premised on the idea that what has happened in the past gives traders an idea of what is likely to happen in the near future. So you'd want to study the charts so that based on the structure that you're able to identify, you'd be able to know when to trade. So though there is a specified minimum amount of time required for direction to be considered a trend, the longer the direction is maintained, the more notable the trend becomes. So you cannot tell as a trader how long the trend will prevail or will persist. And that being the case, the best that you can do is to mark key levels so that those key levels would be able to guide you as price continues to unfold in order to know when that trend ends. And that being the case, the best that you can do is to mark key levels so that those key levels would be able to guide you. Where the trend is stable and steady over a period, it indicates consistency and invokes more certainty regarding the direction of the price movement. So when it comes to the types of trends, there are three types of trends. Where the trend is stable and steady over a period, it indicates consistency and invokes more certainty regarding the direction of the price movement. Just give me 1 second. I'm just trying to mute the noise in the background. Give me 1 second. Just give me 1 second. I'm just trying to. So there are 3 types of trends. So the first type of trend is an uptrending market. So this is a market structure where price would be on a progressive upward movement within a specified period of time. So it's also regarded to be a bullish uptrend. The structure would consist a series of higher highs and higher lows. And in an uptrending market, each successive peak and trough is higher than the ones that had formed earlier in the trend. So you'd have such a structure. So the market would make low points. So the low points are called troughs. Then that would be followed by a high point, which is called a peak. So the troughs and the peaks would continue to form, and progressively you'll be in a position to identify a pattern where price would form new highs and new high low points. And when you have such a structure, you'd be able to know that that trend is an uptrend. So the market would rise and fall in a zigzag pattern, ascending higher and higher over time. So the peaks are called higher highs and the low points are called higher lows. The second type of a trend is a downtrend. This is a market structure where price gradually moves low, making impulse moves to the downside and corrective moves to the upside. It is also regarded as a bearish trend, and price tends to form a series of lower highs and lower lows. Each successive peak and trough is low than the ones that had formed earlier in the trend. So you'd basically have such a structure. The peaks here, or the high points, are referred to as lower highs. So these are lower highs. And the lower points, or the low points, are referred to as lower lows. So again, you'd have market rising and falling, forming a zigzag pattern. And if price is on a progressive downward flow, then that would be regarded to be a downtrend market. Then lastly, we have a sideways trend. So this is a trend where price action is confined within boundaries of support and resistance levels. It is also referred to as a range, and the highs or the top areas is approximately the highs within that sideways pattern would be almost at an equal level. The bottoms would also be almost at an equal level. So unlike uptrend and downtrends, here tops and bottoms would be within the same zone or within the same level. So a range is more likely to break out either above or below the resistance. So you'd have such a pattern. Though price would rise and fall, it would be confined within a horizontal channel or range. Now, there are several number of tools that you can use. One, to identify the trend. And once you've added these tools, they would form part of you'd be able to use them within a context. So you'd want to add them so that you can be able to use them within a context in order to identify when to enter into a trade. So these tools will give you just one trigger among many which you'd expect to manifest before you can know that you can enter into a trade. So the first tool that you can use is a moving average. A moving average is an indicator, and it tends to smoothen out price data by creating constantly updated average price. So moving average is a line, or it's presented in a linear format. And once you've added a moving average on your chart, you'd be in a position to identify where the average price lies. So this would help traders to understand the direction of the price. By adding a moving average, the impact of random short-term fluctuations in price are mitigated. So you'd be able to have a smooth flow, thereby knowing the most optimal point to consider entering a trade. So moving averages are used to identify areas of dynamic and support along an uptrending market. So moving averages are more effective when price is trending up or down. So when there's a strong uptrend or a strong downtrend, moving averages can be quite effective to identify your entry points and exits. They tend to be less effective when the market is ranging or when the market is confined within a horizontal zone. So when you add moving averages, you'd have such a picture. So these two lines are moving averages, and they're helping you to identify the flow of the price as price continues to form on the chart. So upon adding them, you'd be in a position to identify when to enter. So like in this particular context, you will notice that there's a tendency for price to move towards these two lines. So I'm talking about these two wavy lines. So there's this red line and there's this blue line. So under normal circumstances, you'd have price making an impulse move to the upside. But once that push has ended, price would tend towards the two moving averages. Price would tend to push towards the two moving averages. So you basically await to have price pulling towards the two moving averages, or even a single moving average if you're working with just one. And depending on the kind of reaction that you'd have, once price is close to the two moving averages or the moving average that you're using, then that is what would help you to know whether you can take a trade. So in this case, you try to buy along an uptrend once price starts to deviate higher. So the areas marked with a red arrow would indicate your optimal entry points for buy positions. In this context, we have a chart and the prevailing trend is to the downside. So in this case, you'd wait for the price to push downwards. Once it rises to retest the moving average zone. If it fails to break above those two moving averages, you'd want to sell once price begins to drift to the downside. So areas marked with a red arrow would indicate areas where you'd find an optimal entry for a sell. And as I had pointed out, you should always try to align your trades with the prevailing trend. If the existing trend is to the upside, it wouldn't make sense to buy. It wouldn't make sense to sell. The best decision or the best kind of trade to take would be to take buy positions. On a downtrending market, instead of buying, it would be much more beneficial to sell along the peaks. So the peaks would offer optimal entries for sell positions. The second tool that you can use is a trend line. So a trend line is a line which connects several swing lows or swing highs, either along the peak or along troughs, along a diagonal zone. So a trend line connecting higher lows along an uptrending market is called an ascending trend line. A trend line is drawn along top of easily identifiable higher lows along a downtrending market, and this trend line is called a descending trend line. So this is an example of an ascending trend line. So you'd have price rising and falling, and if that structure would enable you to connect several low points, so these low points are regarded to be higher lows. So if you cannot connect these higher lows, multiple along a diagonal zone, then you can be able to mark your area of support. So ideally, by adding this line, you'd be using it as a point of reference as price continues to rise and fall. So the essence is to wait for the price to drop towards that area that you've marked, and depending on the reaction, then that's what would guide you to know whether you'd buy or whether you'd sell. Ordinarily, when you have an uptrend, you'd be seeking to buy as price rises off that trend line. So as price bounces off that trend line, that would offer you the most optimal entry for a buy. Conversely, you might as well have a case where you might be able to connect several peaks along a descending gradient. So in this case, this line is referred as a descending trend line. So with such a structure, you'd want to sell once price pushes towards that trend line. So by marking it and extending it further ahead, you'd be waiting for the price to rise, and once it retests that trend line and fails to break above that trend line, once price begins to drift to the downside, then that is the most optimal time to enter a sell position. The last tool that you can use is a channel. So this is a chart pattern, and it's created using two parallel trend lines along an uptrending market or a downtrending market. So it is an important tool in technical analysis that can be used to determine optimal entries to buy or sell. So the upper trend line would mark the resistance zone, while the lower trend line would mark the support area. So you'd have such a structure. So this is called an ascending channel. So price action would be confined within that channel. So you'd have price dropping and rising. So price would tend to test or to retest those two trend lines. So when you have an ascending channel structure, you'd want to buy along the lower trend line. So you buy once price has dipped and retested the lower trend line. So like in this case, this area would offer an optimal entry for a buy. Ordinarily, you'd put your stop loss below that trend line, and you'd be targeting to increase your reward to risk. So you'd be targeting for the price to push higher, to rise towards the upper trend line, or to retest the upper trend line. So the kind of move, the kind of impulse move that you'd be targeting to capture would be way bigger as compared to the amount of risk that you'd be taking. Similarly, you might have such a structure. So this is what you're calling a descending channel. So in this case, you'd seek to sell in line with the trend, and your entry for a sell would be a case where price would rise to retest the upper trend line of the channel. So if price fails to breach above that trend line, then you'd seek to sell as price begins to reverse along that trend line. Your target area would be to exit your trade as the market approaches the lower line of that channel. So those are few tools which you can put into use in order to identify entries and exits. So if we can now jump into the charts, we can try to spot such tools which are currently prevailing on a few charts. Entries and exits. So we can now jump into the charts and try to spot such tools which are currently prevailing. A few charts. So the first asset which I'm closely watching is euro dollar 4-hourly chart. So on euro dollar 4-hourly chart, you have a very nice down channel. So this down channel would guide you to find optimal entries to sell. So the first asset which I'm closely watching is euro. So at the moment, the market is retesting the lower trend line of the down channel. So in this case, the essence is to wait for the price to rise. So once price rises towards the upper trend line, if it fails to rise above that level, you'd seek to take your entry for a sell somewhere close to that trend line. So this is a nice structure which you can currently put to use to identify optimal entries for this pair. Another asset is euro against kiwi. So on an hourly chart, this asset has formed a very strong up channel or ascending channel. So for this case, the most optimal entry would be to buy, and your entry would be a case where price has dropped towards the lower trend line of the up channel. So once the market retests that trend line, if it fails to break below that level, then chances are high to have an upward price continuation. So I should insist that this should not be the only reason why you should seek to buy or sell, but it gives you one reason among many why you'd seek to take a trade on that asset. So you should also be keen on the fundamentals that are prevailing at that point in time. So you should ensure that they align with the current trend. Another asset is pound against Canadian dollar. So this has had a prolonged down channel, and this structure would have offered you nice opportunities to sell along the upper trend line. So market would rise, it would retest the upper trend line, and upon failing to break above that resistance, you'd have a huge impulse move towards the lower line of that channel. Moving forward, price would rise again, and once it retests that upper trend line, failure to break above, price would progressively move lower, and that would give you very big moves to take. As you can see, I've also integrated some moving averages just to help me to know when to enter into the trade. Lastly, we have euro against New Zealand dollar. Sorry, Australian dollar against New Zealand dollar. On a daily chart, we have an ascending trend line. So as you can see, price has had a tendency to drop and rise, drop and rise, drop and rise. And if you take, or if you pick your trend line, so this is the icon for the trend line. So if you pick that trend line and draw, stretching it to connect those low points, you'll notice that all those points lie flat along that trend line. So when you mark that and push that line further ahead, you'd want that trend line to act as your point of reference. So it will be a key tool to help you identify when the market is reaching your area of support. So this trend line would therefore serve as your area of support. So upon price pushing towards that trend line, then you check your fundamentals just to ensure that they align with the current market trend. And if you have other triggers, then you can as well use those triggers at that point in time in order to identify whether you can take that trade. So basically, those are the 3 tools that you can use to try and find setups to trade when you have strong trends in the market. So with that, we come to the end of today's session. I hope that you've been able to learn something, and it will be of great use as you try to trade. So that's it for today, and I look forward to interacting with you in the near future. So that's it for today, and I look forward to interact in the near future.